Hey everyone, and welcome! If you're getting ready for the SCMPE paper, you know that analyzing performance is, well, it's everything. Today, we're going to break down sales variances, and I'll give you a powerful way to diagnose sales performance like an absolute pro.
Okay, let's just dive right in. Here's the game plan. Think of this as an investigation. We're going to follow a really clear path, starting with that big top-level number, and then digging all the way down to the root causes. It's a logical flow that's absolutely crucial for the exam.
And this is the central mystery we're here to solve. It's a classic business problem, right? You see sales going up, but the bottom line is getting worse. The answer is always in the details, looking past that headline revenue number. And that is exactly what variance analysis lets us do. All right, so first things first, we need to figure out what we're actually measuring. To really get a handle on the sales team's performance, we have to look deeper than just revenue. We've got to focus on the thing that actually drives profit.
So why do we start with contribution? Why not revenue? Well, the logic is all about control. Your sales team has a direct say over two things: the price you sell at and how many units you sell. Contribution, which is just your sales price minus your variable costs, perfectly isolates their impact. It shows you the real cash each sale is generating to help cover your fixed costs and ultimately to make a profit.
Okay, so we've got our key metric. Now we can start our investigation at the very top. We need that big picture view first. Did we do better or did we do worse than we planned? Simple as that. This is what I like to call our level 1 diagnostic, the total sales contribution variance. It's the ultimate bottom line of your sales performance. It's the total difference between the contribution you actually made and what you thought you were going to make in your budget. This is the total problem, or maybe the total surplus that we now need to explain. And the formula for it is, thankfully, pretty simple. The sales contribution variance is just your actual contribution minus your budgeted contribution. Now, one really important thing to remember is that we use standard costs here. Why? Because we want to isolate the performance of the sales team, not the efficiency of the factory. If the number you get is positive, that's a favorable variance. Awesome. If it's negative, it's adverse. And that's where our real investigation begins. So that total variance tells us what happened, but it doesn't tell us why. To figure that out, we have to peel back the first layer of the onion. We're going to split that total variance into two big pieces. Was the difference because of the price we charged, or was it about the volume of stuff we sold? The price variance is our first suspect. It zeroes in on one simple question. Did we make more or less contribution just because our actual selling price was different from what we'd planned? Let's walk through this formula. The price variance is the difference between your actual contribution per unit and your standard contribution per unit. Then, and this is the key part, you multiply that difference by the actual quantity you sold. By using the actual quantity, you're isolating the impact of your pricing decisions. You're basically asking, for every single unit we actually sold, how much extra or less contribution did we make just because of the price?
And now for our second suspect, volume. This variance tackles the other half of the puzzle. Did we make more or less contribution simply because we sold a different number of units than we budgeted for? And we assume, just for this calculation, that our prices hadn't changed at all.
So let's look at the formula for the volume variance. You take your actual quantity sold, subtract the budgeted quantity, and then multiply that difference by the, and here's the exam critical phrase, the standard contribution per unit. Why standard? Well, because we want to isolate the effect of just selling more or fewer units. By using the planned profit per unit, we totally remove the impact of any price changes because we've already dealt with those in the price variance.
So here's the crucial point, and honestly, this quote is exam gold. Why do we keep using standard contribution or standard cost? It's because the sales team controls the selling price and the volume, right? They don't control how efficiently the factory runs. Using standard costs isolates the sales team's performance, which is the whole point of this entire analysis.
Fantastic. Now let's get even more granular. We figured out our volume variance, but was that because we sold a different combination of products, or did we just sell more or less overall? This is what we call the mix and quantity puzzle. Think about it like a coffee shop. Let's say you budget to sell a ton of high-margin lattes, but what you actually end up selling is mostly low-margin black coffee. Even if you hit your total number of cups sold, your profit is going to be way down. The mix variance measures exactly that effect.
Now, I know this formula can look a little intimidating, but let's just break it down logically. We're trying to isolate the effect of the sales mix. So we compare the actual quantity sold of each product to something called the actual quantity in budgeted proportions. All that second part means is, hey, based on the total number of things we sold, what should the mix have looked like according to our original plan? You find that difference and multiply it by the standard contribution. That gives you the exact dollar impact of selling the wrong or right combination of products.
The quantity variance, then, just strips out that whole mix effect. It tells us what would have happened to our contribution if we had sold our products in the perfect budgeted mix, but we just sold a different total number of units. It purely measures the impact of overall sales volume. And you can see this really clearly in the formula here. We take the actual quantity sold in budgeted proportions, which we just calculated for the mix variance, and subtract the total budgeted quantity. This zeroes in on the impact of overall sales volume, assuming that mix was perfect. And of course, we multiply by the standard contribution. Here's the cool part. When you add this quantity variance to the mix variance, they will perfectly add up to that total sales contribution volume variance we started with. We're almost there, almost at the root cause. We've analyzed all the things that happened inside our company. Now, for the final layer of our investigation, we need to look outside. Was our performance just due to our own sales efforts, or was the whole market changing around us? And this perfectly illustrates that final breakdown of our quantity variance. The market size variance is all about the whole industry. Did the tide rise for everyone, or did it go out? Then, the market share variance is all about us. Did our slice of that market pie get bigger or smaller?
These last two formulas break our quantity variance down into those external factors. The market size variance tells us if a rising tide lifted all boats. It calculates our share of the entire industry's growth or decline. The market share variance, on the other hand, isolates our own competitive performance. It calculates the financial hit or gain from our market share percentage changing. A favorable variance here is a huge deal. It means we actually beat our rivals, and that is a powerful insight for management.
All right, that was a pretty deep dive. To make sure all of this sticks in your brain for exam day, let's lock it all in with a super quick rapid-fire recap of every single variance in the diagnostic chain we just built. You ready? Let's run through the whole chain. At the very top, you have the total sales contribution variance. That breaks down into the price variance and the volume variance. That volume variance then splits again into the mix variance and the quantity variance. And finally, that quantity variance is explained by two external factors, the market size variance and the market share variance. And that's it. That's the entire logical flow from top to bottom.
And that brings us to the end. But here's a final thought for you. This stuff isn't just about calculating numbers to pass an exam. It's a real strategic tool. So, how would you use this detailed diagnosis, knowing your exact price, mix, and market share effects, to set smarter, more motivating, and more effective targets for your team? That's where the real management skill comes in.